How can you ensure your directors have the right information to make informed decisions for the present and the future? For those of you who are regular attendees at our webinars, you know we host these to give you timely, valuable information that you can take back to your association and use immediately. These webinars also give us an opportunity to help you see some of the work that we do. So when you're looking for help, you'll think of us. Let's get started. Often I find that we end up with people on our board of directors that are all fairly similar. And that's because it's a professional association, it's an industry association. And so therefore you might find that depending on who you are, what kind of an association you are, you've either got people around the table who all get numbers and are totally comfortable with them, or you may find a situation where most of the people around your table are not comfortable with numbers. They don't use them on a daily basis. And maybe you've got a board that is challenged to do a really good job of reading financial statements. Regardless of who's sitting around the boardroom table, your board needs to make timely and informed financial decisions. That's critical. It doesn't matter what their level of expertise is. And in order for them to do that, they need the right information provided in the right way at the right time. So in an ideal world, we've got a situation where our financial statements are clear, they're simple, everybody understands the financial statements, they ask the right questions. That's our ideal situation. But given the fact that that isn't necessarily true, even if your financial statements are absolutely brilliant in every way, it doesn't mean every director is going to understand them. So you want to make sure that you are providing a narrative, whether it's you as the CEO, whether it's the treasurer, whether it's the CFO, you want a narrative that goes around that. And that could be written, it could be verbal, or it could be both. But either way, what we're looking at here is something very short. So they got the numbers, they've got the explanation. Because what really has to happen after all of this is the directors need to make the right financial decisions in a timely manner. And if they understand the information, they should be able to do that. So what we're going to be talking about today is, what is the right information? What does the board need? What kind of metrics and comparisons should we be sharing with them so that they have better information? And what kind of format do we want to present that in? So what the directors really need, and I think this is the most important takeaway here, is directors need to know when to ask questions. You need to know when to ask questions and when to dig down and have answers in advance of those questions. Because what really needs to happen is, as a CEO, as a member of the board of directors, as the board itself, we need to be able to predict outcomes based on what we are seeing in the financial statements right now. Remember, the financial statements tell us where we are at this moment in time. That's it. That's all they give us. They can give us trends if we want to go back in time and look at them, and I do encourage you to do that. But what we really need to do is to take our knowledge, look at those financial statements and say, okay, where is this going to get me by year end? Where is that going to get me 3 months from now? Being able to predict outcomes is really critical. So in terms of what we need to know, in terms of the right information, at a minimum, we need to know how we're progressing against our budget. Anything that has come up that seems surprising, is unexpected, or is expected, and we've been proven that we predicted correctly, these are the things that we want to be able to be sharing with the board. And also with the board, it's critical to not just give them information, but to tell them this is what it means in terms of what we need from you. So here's the information. No action decision is required. Or here's the information. We need a decision on this, and we need actions, and here's who we need them. So keep in mind that the board not only needs to be able to be told what they need to know, but what's required of them in terms of next steps. And it may just be awareness. So let's start with the balance sheet. Just in terms of what's on the balance sheet can be very intimidating to non-financial people. And I admit I am still learning about balance sheets, and I have much further to go. But it's really important that your board understands at least the basics of what's going on in the balance sheet. And if you're the CEO, you certainly need to know that as well, too. You don't want to be misinformed or ill-informed about what you're looking at. So just in terms of the 3 things that you got in your balance sheet, you got your assets. That's what we own. That's ours. The liabilities are what we owe for one reason or another. And that doesn't necessarily just mean debt, but what we owe in general. And what's left over is our surplus. It's our net equity. It's the assets minus liabilities. Now, one thing I'll suggest to you here, when you get a balance sheet, it would be totally normal to see here's where we are at this point in time, and here's where we were at this point in time last year, and that's helpful information. What I also like to see on the balance sheet is I'd like to know where we ended our last fiscal year. So I know what our cumulative surplus was going into this calendar year, this fiscal year rather. That gives me either a great sense of comfort or a great sense of concern. But either way, it's important information, because if it turns out that we went in with a really healthy surplus into this calendar year, we are better fiscal year, we are better able to get through any financial challenges we might come up with. If we really didn't come in with much, then we've got to take action really, really quickly if it looks like we're not going to make budget. So it's just a helpful metric to have sitting there. In terms of the income statement, what you are going to have in your income statement at a minimum is where we are at this moment in time, actual year-to-date numbers for revenue and expenses. What you also want to have on there at a minimum are two other things: your budget, where's your budget for the year, and where were you last year at this moment in time? And both of those things are really helpful. But the year-to-date one is at least as helpful as the budget, and it's especially helpful in the early part of your fiscal year, when you can't be expected to be anything close to budget because you aren't anywhere near far enough along in the year. So let me give you an example. This is a very simple income statement. You've got your revenue, you've got expenses, and then you've got your surplus or deficit at this moment in time. So what does that tell you? It tells you we've got revenue of 450, expenses of 300, and at this moment, we've got a surplus of 150. Okay, that's great, but it really doesn't tell us anything. When you bring the budget into it, now let's just say we're 3 months into our current fiscal year. Now we're looking at the budget. We see we've budgeted $1 million for revenue, and we're less than halfway there. If we're only 3 months into the fiscal year, that's probably not a bad thing. I mean, we've got 9 months left to get to $1 million. But the question you should be asking is that enough time to get to $1 million? It probably is if our income comes in more or less regularly throughout the year. But if our income all comes in the first 3 months of the year, we are already out of runway. So there's no way we're going to be able to make up that revenue. So timing is very important, and that's an important piece of information you want to have in your management report. Now, let's look at the year-to-date column. That tells us even more information. It looks like last year at this time, we had $600,000 in revenue. Right now, we only have $450,000. Why is that? Is that the beginning of a trend we need to be aware of? Is it just a timing issue? And same thing when you go and look at expenses. $300,000, we're 3 months through the year. That's a third of what we had budgeted. That doesn't sound unreasonable. But look at our year-to-date number. It was 210 last year. It's 300 this year. Why are we up by such a large percentage? So basically what you're looking at here, the more, I don't want to say the more comparatives, the better. That's not true. Having the right and a simple number of comparatives and knowing when to ask the questions, that's really useful. So before I would take this to the board, I would be prepared to answer the question, why are we so far behind where we were last year at this time? Do we have a reasonable chance of getting to budget? And what's going on with our expenses? Why are they higher than they were at this time last year? So that's the kind of stuff that you would want to have in your management report. We'll talk about that in a couple of minutes. Things you might want to consider adding to your financial statements are, if you've got some elements of your budget that actually you'd like to see more detail on. So let's say you've got a signature event. You might want to have a separate schedule that gives you all the detail for that event, not just the high-level revenue and expense items, but right down to what you spent on AV last year, for example. So a signature event, you might want to have a separate schedule. You might want to have a separate schedule for a specific member program. If it's something that is a meaningful contributor to revenue and or expenses, you might want to have a separate, more detailed schedule for that. And trend analysis, and we'll talk a little bit about trends to be watching out for, could be helpful as well too. Where have we been over the course of the last 3 years with respect to this particular line item or this particular group of line items? Now, when it comes to showing your revenue, I find that it's really useful to keep percentages for your revenue so that you really know where is the majority of the revenue coming from and how does that compare with your other revenue sources. So you could show revenue on a rolling 3-year basis. So for example, If this is the end of 2023 here, we know that membership dues was about 90% of our gross revenue. And if you just look at that on a standalone basis, that is useful information in its own right. Because if you've got 90% of your revenue coming from membership dues, what that means is if you get a meaningful drop in revenue, you are almost immediately going to have to be thinking about cutting back on what your expenditures are on member services, unless you've got a massive surplus in the bank. So that's something to think about, useful information. It tells us 90%, so we know we've got risk there, and that's something the board needs to be aware of. But if we look at the trend and we see where we've been going for the last couple of years, we see that membership dues has become an increasingly larger percentage of revenue. And the reason is because sponsorship has dropped dramatically. So seeing that 3-year trend is very useful. Maybe it didn't drop until 2022, and then it was a precipitous drop. Those are the questions that we need to be answering when we look at these comparatives. And by having the comparatives, it enables you to go, wait a minute, I've got to dig down on that. I need an answer to that. And that answer will tell you, is this something that we need to do something about? Is this something we just need to monitor? You know, what level of action or decision-making is required here? Now, when we look at our income statement, we want to, like revenue, we want revenue broken down by source. We want expenses broken down basically by program. So when we're looking at our expenses, we want to know what expenses are relevant, how big they are, and what are our major sources of expenses. Now, in an ideal world, your administrative expense or your salaries and compensation is usually your biggest line item. And there's reasons for that. If you try to break that out too much, it might show or allow people to guess individual compensation for individuals. That's not really what you're looking for here. But if you've got Bob who spends all of his time on a specific member program, you can reasonably and justifiably allocate Bob's compensation to that program. Sometimes it can get complicated and it may not be worth doing it, but if you can do that and you can find a relatively easy way to break those things down, that can be really helpful in defining the true cost of a program. A conference, for example, if you look at a conference and you look at the expenses for the conference, it usually doesn't include the percentage of time that the individuals who are part of staff are spending working on that conference. But if you hired an external event manager, you would put that straight into expenses. So if you don't have your internal staff costs accounted for, you are definitely underestimating the cost of your conference, and you need to be able to get that information from another source. But if you can break it down, that's really helpful. Also, it really helps to be able to see the trend for the last couple of years. What's going on with our expenses? Look at this particular set of trends. Well, it looks like the expenses on the conference have gone down a bit. Is that because we have fewer attendees? Is that because we've done a great job of negotiating, venue costs or something else? You want to be able to look at these numbers, see the trend, and see what kind of questions you need to dig down on to get some answers. And those questions and answers are going to be what forms the basis of your management report. So in your management report, which again can be written, it can be verbal, or it can be both. But what it needs to have in there is, what does the board need to know? Yes, I know it's all in the board package. You just have to dig through it, but let's make it easy for you. I'm going to give you maybe 1 or 2 paragraphs in a management report, maybe 3 to 5 minutes in terms of a verbal report. Both is better, but don't skip the verbal report, because sometimes that's going to be what people pay attention to, and it doesn't have to be long, and it shouldn't be long. So what should be in our management report? What matters here? Well, we want to make sure that they know of anything that's come as a surprise. When you're making the budget, you're predicting the future. You don't know whether it's going to be right or whether it's going to be wrong. You just know that some things are going to be wrong. So are there any things that have been identified as risks in the budget? And if so, where are we tracking to those risks that we identified? Are there risks that we didn't identify in the budget that have suddenly come up? We've just realized that, a major revenue source has gotten a lot smaller than we had expected it to be. Any trends, any anomalies, anything that is leaping out, you want to make sure that you're giving them the same kind of information that somebody who is astute in reading your financial statements would have seen as something that pops out at them and would have been a relevant discussion point. If there are any decisions required, you want to make sure that the board knows what's expected of them. So is this something that we need to do something about? And I encourage you in your management report, end with something along the lines of, here's what's needed from the board, or no action decision is required at this time. Let them know what your expectations are for them. Now, when we're talking about decisions, what we need to know, what the board needs to know, is this a board decision that we need? And if so, is it on the agenda? Is it something that we need to have a vote on? Keep in mind, if you want to have a very rigorous record of what the decision was, you're going to have that in your minutes. But if you also have a vote, then that's going to be recorded in the motions for the organization. And sometimes that might make it easier to find. So you need to decide, is this just a decision or is it a vote? Now, it might be that the board is not going to be in a position to make a decision right now with this information. So you might be saying, what we need here is we need to strike a committee to dig down into this and come back with a recommendation to the board for them to make a decision. So tell the board what you need from them and what the next steps are. Now, in your management report, when you're talking about risks, the kind of things that you would want to explain are things that either you've already identified and we're just tracking to that risk and where we are against it, or new things that have come up. Are we seeing, a trend in one of our cost elements or our revenue elements that we weren't expecting? Are we looking at maybe for the first time ever, our year over year revenue numbers are slightly lower than they were last year? I mean, if that's been a trend that's been in place for several years and you're already working on it, that's one thing you want to be tracking it. But what if it's happened for the very first time? Maybe it means nothing, maybe it's an anomaly. But what you want to do as the CEO or the CFO is drill down and find out why that is happening. So you're in a position to make sure that you're able to answer that question for the board. Now, in terms of risks and negative trends and all that kind of stuff, at what part of the spectrum should you be in? Are you in complete complacency where you've got your head in the sand and every piece of negative news or worrisome news that comes up, you go, no, that's just timing, or no, we don't have to worry about that? Or are you at the other end where you're panicking at every little thing? Obviously, you don't want to be in either position. My personal feeling is I always veer more to, do I see anything that looks remotely worrisome? I want to ask some questions about it and drill down. Then I need to decide if it's something that the board needs to know about or it was just a timing issue. Either way, I want to make sure that I'm prepared to share it with the board. Okay, here's something that looks a little odd, but don't worry, it was because of this. It's a timing issue, and they know and they understand. So in your management report, you don't want to veer into complacency, but you don't want to panic the board. You just want to make sure that they have all the information they need. Keep in mind, by the time the board gets to the end of the year, wherever we are against budget should never be coming as a surprise to them. You should have been, as the CEO, as the CFO, as the treasurer, leading them toward that conclusion throughout the year as you see the signs of where you're going. Now, in terms of your wins and your progress, we don't want to confine your management report to, here's what you need to worry about. You want to make sure that you're showing them, this is what we had predicted, and isn't it great? This is what actually happened. We've made progress toward this. We expected this win. In fact, we budgeted for it. We've got it. We've got this new revenue source. Or we had budgeted to spend a certain amount on our signature event, but we've managed to save significant costs by doing this. Make sure that any good news and bad news are both reflected in your management report, not just so the board needs to know, but also just for human need reasons. We all want to have good news and not just bad news. In terms of trends and anomalies, anything that is unexpected. So if we see a spike in our revenue, a spike in our expenses, and again, the year-over-year numbers are really helpful for that, that's the time to ask a question. Drill down, ask your team why this might have happened, if they can explain it, and then you decide based on what you know about it, how you're going to transmit that information to the board. One thing to keep track of, and I'm only mentioning this, it seems like motherhood, but I see it frequently enough that I want to mention it. I've often seen situations where, and this could often go on for a long, long period of time, in some cases years, where you see the membership numbers are being reported as maybe flat. We've got basically the same number of members we had last year and the year before and the year before that. And then you look at the membership revenue and you see membership revenue has been tracking down a little bit every year for the last 3 to 5 years. How can that be? That provokes a question. It could be that we've got a free member program, and increasingly the number of members that are free has been increasing over time. Okay, well, that's something the board needs to know. But what I often see, and this is more of a worry, that in fact our membership numbers as reported are inflated. Now, this can be for a couple of reasons. Sometimes you get a situation where nobody wants to tell the board that the membership's going down. And of course, that would be a really bad thing. Sometimes we have a situation where the association management system we're using is just really bad at reporting. Again, a bad thing that has to be fixed. Or what is often very common is we end up with a situation where we just don't cut off members when we should. 6 months later, we're still chasing them down for membership fees, and we're still reporting our membership as being what it was at the end of last year, even though 20% of them haven't renewed. Again, I know that boards will often contribute to this. I will often hear boards say, oh, no, we don't want to cut them off after 30 days or 60 days or even 90 days. They could get pissed off at us that we stopped their member privileges, and then maybe they just won't renew at all. Believe me, it doesn't work that way. If you have a reasonable cutoff period, and by reasonable, 30 days is reasonable. Remember, they haven't paid for 30 days. They're in arrears by 30 days. It's okay to cut them off. As long as you've given them plenty of notice. I've never seen a situation where an organization has gone to a clear cutoff date where people have been very clearly reminded and noted that this is what's happening. I've never seen a situation where this has resulted in less renewals as a result of letting people know that. But boards often feel that. Boards are very, very reluctant to do anything that they think is going to be taken negatively by the membership. So you need to make sure that you're on top of that and you are prepared to deal with it, and you've got a policy for how to deal with it. In terms of your management report, you want to make sure that about halfway through the year, you should start predicting what the impact is going to be on your year-end budgeted position. So let's say you've expected that at year-end, it's going to be a balanced budget and we don't have a surplus, we don't have a deficit. That's what we're expecting. Around about halfway through the year, you want to make sure that you are predicting what your year-end actual is going to be. So make sure that the board knows, okay, we were expecting we were going to end up with no surplus and no deficit, but it looks like we are going to have a slight surplus. That's my best guess at the moment in time. Or it looks like we're going to have a slight deficit. We want to make sure that we are predicting that year end. So by the time we get to the year end, remember what we talked about earlier, there's no surprises for the board. You've been telling them for the last 6 months that this is roughly what we had expected. So in terms of a summary, we want to make sure that the board has the right information, the right comparatives and metrics, and the right format. When we talked about the right information, we talked about how we're doing against budget, particularly any surprises, any risks, wins and losses. In terms of our comparatives and metrics, we want to make sure we're showing budget against actual at all times, which is typically what you would have in your financials. Where we were last year at this time, that can be a very helpful and very useful piece of information, and what your prediction is for the end of the year. You can't do that in month 1 or month 2 of your fiscal year, probably, unless something big has happened. But make sure that you are giving them regular predictions of the year end. Now, in terms of the right format, you need to make sure that your financials are in the right format and that your management report is in the right format. I encourage you for your management report to have a very short written version and a very short verbal version as well. But if you don't do both, make sure that you do the verbal version. In terms of the financials, we need to make sure that the financials are being presented in a way that is going to make sure that the board has the information that they need to make informed decisions. So what I'm going to do now is I'm just going to summarize with a few tips. First of all, if your bookkeeper / accountant / CFO is using your accounting system to create invoices for your member renewals when member renewals are coming up, you can end up in a situation where that automatically ends up in the balance sheet as accounts receivable. You don't want that to happen. Remember, every year that somebody chooses to renew, if they have a choice in the matter, in other words, membership is optional, you've got no certainty that that actually is revenue that's going to be coming in the door. And you shouldn't have anything in accounts receivable that is of meaningfully dubious. It's meaningfully dubious that it's actually going to come in. So make sure that that isn't the case with your balance sheet. Also make sure Some organizations, they account for their for everything on a cash basis. If you've got a reason for doing that and things are relatively predictable, maybe that's what you want to do. But as a general rule of thumb, that's not a good thing. When we're getting in our membership payments, and let's say that you start 2 months in advance, which is a great idea. You want to make sure you're giving people plenty of notice, and you are fortunate enough to have members that pay before the expiry date, then you're going to have revenue that's coming in the door that is not attributable to this membership year. It's attributable to next membership year. So for now, that information is going to sit on your balance sheet as deferred revenue. You're not going to bring it into your income statement until your membership year starts. Now, keep in mind, I'm assuming membership year and fiscal year are the same for you, but in some cases they're not. And where they're not, it's membership year that you're looking at here. In terms of your balance sheet, I mentioned earlier, it's really helpful to show on your balance sheet what your year-end cumulative surplus. You're not likely not going to have a cumulative deficit unless you've got some unusual way of financing it. But knowing that on your balance sheet, I find very helpful. Remember earlier, you've got a membership report and you've got your financial statements. Make sure that your membership revenue is consistent with how you're reporting what's going on with your membership numbers. And make sure that you are consistent year over year. Sometimes it makes sense to change how you are portraying something in terms of your financial statements, and you should always be looking to improve. So it's a good thing to improve how you're presenting things. But you got to think about, as you do that, what impact is this going to have on me being able to make a comparison with next year to this year and the previous year? So you got to think about how that comparison is going to work and what kind of things you have to be doing in your head to make comparisons to the way the financial statements are now versus the way they were a couple of years ago. So just figure that out first before you actually make the changes, and make sure that you're prepared for them, and discuss it with your treasurer and then with your board as well too. So in terms of the next steps, you want to make sure you develop your metrics, know what you're going to track and how to track it. Think about, do you want to modify how you're doing your financial statements? Are you doing a management report right now? Remember, verbal is fine. Just make it quick and make it focused and make sure the board knows what you need from them. If you're going to write it, make sure it's short and make sure you do it the same way every time. And also make sure that what you're going to be looking for in terms of presenting to the board, talk to your CFO. Does your general ledger support the kind of reporting that you're looking for? Is it going to take the CFO an extra 6 hours a month to produce the financial statements because you want certain figures? Well, if that's the case, you don't want that to be going on for a long time. You want to make sure that you're investing in your financial infrastructure. And that might be, now that becomes a project for the CFO, and maybe that's going to take a week or 2 weeks to get that sorted, and you got to give them the time to do it. Or maybe you need to invest in a different kind of financial system that's going to make that kind of reporting more easily. Finally, train your board. Not everybody feels comfortable with numbers, and most people, I have learned, will not admit they don't feel comfortable with numbers. It's a rare person that does admit that. And when they do, pump their hand and congratulate them. You want to make sure that everybody has the training that they need in order to do a good job of making informed financial decisions. If you need some help taking your board forward, you know where to find us. We do that, and we'd be happy to help. What I'd like to do now is I'd like to go to Q&A, but before we do, we have a message in chat, and the message is we were sued for cutting them off to the tune of $20,000. Really good point, and thanks, Carrie, for sharing that. Obviously, you want to make sure that you know what the implications are of cutting off your members, and if you are in a situation where cutting them off would mean a change in their ability to go about their business and their livelihood, that will have a greater impact. But please keep in mind, from a legal perspective, you got to know where you stand. And if from a legal perspective, you're in a position where you can't cut them off even if they don't pay, then there's probably something wrong, and you probably want to investigate that a little further. Kevin, do we have some questions that we can go to?
Yes, we do. First question is, how do you make sense of the balance sheet for the board? Are cash flow reports useful?
Okay, I'm going to take that as two different questions. In terms of making sense of the balance sheet, the first thing I would suggest is get some basic financial statement knowledge to your board. Make sure that you are giving your board the adequate amount of training so that they understand how to read financial statements. In terms of what you're showing on the balance sheet, as to what I had just suggested earlier on the balance sheet, pay attention to those things. Board needs to receive training on how to read them and what to focus on, and what are the things that they should be looking at. So for example, your board should be trained that if they see a sudden jump in accounts receivable or accounts payable, that should raise a question. Really, what they need to know is what should provoke a question. When should I be asking a question? Now, cash flow reports, I got mixed feelings on cash flow reports. It's, for somebody who knows what they're doing, for bookkeeping, they can produce a set of financial statements. That's what they do. That's what they're trained to do. But just because you've got an accountant doesn't mean they can give you a good cash flow report, because you are guessing about what's going to happen to the future. All we know at this moment in time, all we know is what money we have in the bank and what are the things we know we have to spend money on. But often when you're doing a cash flow report, you are having to make an educated guess about what's going to happen in the future. And you don't want to put that all on your CFO for them to be trying to figure that out. So in terms of doing cash flow reports, I suggest you do cash flow reports if you're facing a potential cash crunch. And you should be doing that for every single board meeting if that is the case. But make sure that you get all the people involved that will be able to contribute to the knowledge that's producing the cash flow reports. I will tell you that it is time consuming to do this right, very time consuming. And you want to make sure that if you're doing it, that there's an ROI and you're doing it for a reason.
All right, thank you, Aaron. Second question is, how often should we report financially to our membership?
Well, you're required to report to the membership annually. And I find that that's usually enough. If something has happened, in other words, maybe you're going into a merger situation or an acquisition situation or even a wind-up situation, obviously, as you're heading into that situation, there may be a requirement for additional financial reporting, or if there's a challenging situation happening. And in the interest of transparency, it's appropriate to provide more frequent reports to your members. But as a general rule of thumb, annually at the AGM, that's the time to do it.
Okay, next question is, do you have any recommendations for training resources/courses for someone new to this area who is working towards an executive director role?
Excellent question. I do find, we are a member of the Canadian Society of Association Executives, and one of the reasons we're a member is because there are a lot of resources there. Some you purchase, some are easily available at a low or a free price. There's lots of resources there. So if you aren't yet a member of CSAE, I do encourage you to try to find the budget for that. Between the summit and the conference and the other pieces of information, you can certainly go a long ways towards getting the information you need. Also, the Ontario Real Estate Association, if you know where to find it, has some free resources on their website that's part of their leadership program that they use for training their local boards of directors. So you may find something there. And then, of course, there is the Zeem archive on YouTube of all the webinars we've done. That's easily available. And everything we do is recorded and goes up there. So those are some suggestions that you might want to think about.
All right, next question is, should associations have an annual report? And should they include financials in that report?
Okay, let's start with the second question. If you're going to have an annual report, then definitely include financials in the annual report. But make a good judgment call about that annual report, because if you're going to do it right and do it professionally, it is not a trivial project. It takes work to do it, and it's either going to be staff work or it's going to be money because you've outsourced it. Either way, it's a meaningful use of resources. So make sure that somebody wants to see it. Often I find that annual reports are getting produced because they've always been produced, but nobody's reading them. If you're finding that your board of directors, you're doing an annual report right now, and even your board of directors isn't reading it, well, maybe that's not something that you want to do. But you might find, well, maybe the board of directors isn't reading it, but our stakeholders consume it avidly. So think about the audience. Is there an audience for your annual report? If you're doing one right now, do people appreciate it? Do they value it? Are you getting a good return for the amount of time it's taking to do it? If you're just, and if that isn't the case, then consider replacing it with maybe just a one-pager or maybe just a message from the president, something along those lines. If you're not yet doing it, then figure out who wants to actually see an annual report. So that's critical. Who's the audience, and is this going to be of value?
Okay, thank you, Aaron. We have a question coming through the chat. So on the comment of sharing financials with membership, did I hear this is an essential requirement for all registered non-for-profits? At a minimum, is it annual balance sheets and income statements? One caveat to my question is the non-for-profits I have worked for are based in the US, but are registered locally in Canada as not-for-profits.
Okay, well, let's talk about what we're talking about here is your responsibilities to your members. So assuming that you are a not-for-profit organization and you're registered with federally or you're registered provincially, you are required to have an AGM, and at the AGM, you are required to share your financial statements. Whether or not those financial statements are audited or reviewed by an external accountant is a function of your revenue and what kind of a not-for-profit you are. In charitable situations, you may be required to have an audit regardless. If you're not a charity, but you are not for profit, then if you're a very small one, you might not be required to have an audit or a review.
All right, those are all the questions that we have.
Wonderful. Well, let's talk about our next webinar. We're doing something that we've not done before. Typically, we don't cover insurance in these webinars, but given that things have changed so much post-COVID, I'm finding that associations, even if you're paying the same money you were paying before, it might be that your coverage isn't what you thought it was. So we've taken the opportunity to do a really deep dive into our insurance for our clients. And what we're going to be doing here is talking with Jody Noble, who is the broker for the Canadian Society of Association Executives group insurance program. She does a better job than anyone I have ever met explaining specifically for not-for-profits what the difference is between each type of insurance, why you may or may not want to have it, what level of coverage you should have. So that's what we're going to be talking about at the end of June. We're going to be interviewing Jody Noble. You will find out everything that you need to know to do a deeper dive into your own insurance and to be informed about the insurance that you're actually getting. And that will be on June 27th. Between now and then, Kevin will be following up with you for your feedback. Please give us anything that you can suggest that you would like to see for a webinar topic. We would be happy to learn more about your suggestions for our lineup of learning. That concludes our webinar. Thank you for tuning in, and we'll see you next month.